All right, I want to welcome everybody to our Forex Profits class, where you can scalp your way to $50 to $100 a day minimum. This is our kickoff session. And the one thing about every time I teach this class, I always add a little bit more meat and potatoes. And that was because when I first taught the class, I was trying to figure out what can I teach you that would be really simple, that wouldn't confuse you, because I know a confused mind does nothing. And so as I've taught this class over and over again, I've added more nuggets and a little bit more strategies as we go. So if you've been in this class for the past couple of months, make sure that you always go back and watch the most recent videos, because as I teach the class, I swap the videos out. And there may be some extra information that I'm putting in the trainings that you may not have gotten last time. So always keep up with the trainings. And so I am Angela Powerhouse Williams. I am your master trainer. And we are starting off on session number 1. Uh-oh. Just a second, y'all. I don't know why my screen don't want to be great. Uh-oh. Let me take that off. Okay, disclaimer. I am not a financial advisor. I will not tell you what to invest in, nor pick stocks or Forex trades for you. This training is for educational purposes only. Please be aware that all trading transactions can result in potential loss, and you should only be trading with disposable income and not leverage more than you can afford to lose. Information disclosure: you may not discuss, share, reproduce, copy, reprint, modify, rewrite, or create, publicly display, or on social media, publicly perform, license, or sell content retrieved or learned from this course or presentation slides without the express prior written permission of myself, Angela Williams, owner of Financial GPS 360 LLC. This class is by invitation only. So if you know anyone who might be interested, please reach out to me. Our Powerhouse Scalp Strategy class is a 4-week course. And we'll be going over what Forex is, what the big 3 is that I trade. You're going to learn about market temperature, trend identification. You're going to learn about resistance and support. You're going to learn about risk management. You're going to learn my scalp strategy, the entry and exits. And I'll go a little bit deeper on range trading, as well as candlestick trading, MetaTrader 4 platform, as well as your mobile app. Again, we are using MetaTrader 4. And then there's some additional technical indicators that I have purchased that you are able to put on your charts to simplify the trading process. And of course, you have access to our Facebook members group. Before I kick off, I always talk about the 4 ways that you can make money in America. And Robert Kiyosaki has, he wrote the book Rich Dad, Poor Dad, and he talked about the cash flow quadrant. And basically what he did is he's showing you the progression of how wealth is created and how money should work for you. And so everybody starts in the E quadrant. Majority of us made money by being employees first. As an employee, you trade in time for money. You work 40 hours, guess what? You get paid for 40 hours. Now, the only problem with that is only one stream of income. And as an employee, you don't own your job, so you can lose it at any time. And what we want to, what I really want to talk about is that 40% of all the jobs are going to be replaced by technology in about 15 years. So a lot of people is not talking about that. We have a lot of people that are unemployed right now because of the virus, but there are a lot of businesses that are not coming back, but nobody's talking about the elephant in the room, and that's technology. Technology will be replacing many of your jobs. There is nothing that you do right now that a computer or a robot cannot do. It's just not, okay? And so what you have to do is you got to graduate from the E quadrant and get into the S quadrant. And the S quadrant is people who start small businesses. Now, majority of the people, probably 90%, 95% of the people that is in this course right now are also in my econ with me. So when you join my econ, you move from the E quadrant to the S quadrant, because as a small business owner, you put yourself in position to build additional streams of income outside of your job. And also as a business owner, you get the tax advantages. And if you are doing any form of trading, you need to tie a home-based business to it so that you can keep more of your profits. If not, you trading for the government because they're going to keep majority of that money. And then of course, even though that you have a home-based business, it does require you to do work just like you do at a job. So you still do not have time freedom because all your income is based off of what? You, okay? But you still got to have that plan B in place. And so what you have to do is you have to graduate from the S quadrant to the B quadrant. And the B quadrant is when you have built leverage into your income. And so for the people that's in my econ, that's equivalent to you building your team. Because when you build your team, you are earning residuals, which means you're making money off of other people's efforts. That's what your boss is doing when you work your job. They get more time freedom and they make money because they're paying you a little bit to get you to show up the next day, right? And so as you build your My Econ team, you have an asset, and our asset is people, right? And as they build their business, My Econ is paying you. And so you get that time freedom, you get the ability to learn how to be a leader, right? And those residual checks, we get it month after month, even if we don't get out of bed. And so that's why even though I took a $4,800 hit, I'm not worried about that because guess what? I get paid Friday. Yes, I do. My Econ paid me on Friday. So the money I'm lost, I'm finna get right back and then some, all right? And see, the fourth quadrant is where you all are right now, and that is to become investors. So obviously, if you were in My Econ, we taught you how to build your stock portfolios for long-term investment, but you're in the Forex class so that you can make money, even more money, and you can multiply your money much faster than just investing in stock alone. And so it's giving you some right now money. It's turning you into an ATM machine. That's what your computer and your phone gonna become, an ATM machine. And so as an investor, you are literally taxed at the lowest tax rates in America. Okay, as an employee, you taxed at the highest rate. Okay, and so what we are trying to do is to get you from the left side of the quadrant where you're working for the top 10% and put you on the right side of the quadrant where you are owning your life and you can get 90% of the wealth, because that's where all the wealth is. It's on the right side. We don't know no millionaires and billionaires that work for somebody. They are all business owners. They're all investors in stocks and other businesses, in land, in real estate. And so that's where we want to be. We want passive income. Now, what you're going to learn about trading is that 90% of being successful in trading is your mindset. And 10% is actually going to be based on you understanding the skill set. And so you have to ask yourself what type of mindset you have right now. Okay, so a fixed mindset is somebody who feel like I'm either going to be good at trading Forex or I'm not. And if I'm not going to be good at it, I'm not going to try to be good at it. You get what I'm saying? A fixed mindset is somebody who gets frustrated very quick. And you might be in your demo account and losing money and you quit. You ain't even live. You done lost money in your demo account and you already ready to give up. Or you might have traded live and it didn't work for you and you lost money and you say, well, you know what? Since I lost money, this ain't for me. I'm just finna stop. Stop and do what? Go back to what you've been doing? Because that ain't working. And so if you got that type of mindset, trading ain't gonna work for you. If you don't like a challenge, if you are not a self-starter, if you lack complete discipline, trading is not going to be for you. If you somebody got to hold your hand or somebody got to constantly keep calling you and telling you to watch a video or get on a call, trading is not for you. Because at some point you're going to have to be comfortable trading alone. That's why I teach you how to trade alone. I do not want to create any level of dependency. I want you to be a smart master trader, not a dependent trader. Okay. Now, the other side is somebody who got a growth mindset. And that's just somebody who say, you know what? I don't know Forex. I might not understand Forex, but guess what? I'm willing to learn. And I'm willing to take the time and learn how to do this. Okay. Because I know this is what I want and I'm willing to do it. You are somebody who you do get frustrated. I got frustrated today too, but giving up was never an option. It never even crosses my mind. And so if you're that type of person,
Oh yeah.
then trading is going to work for you. Okay. Now, if you're the type of person that say, if I fail, I'm going to learn, this is 100% for you. Because the one thing when it comes to trading is you're either going to win or you're going to learn. There's no such thing as win and lose. You're either going to win or you're going to learn. Every loss, there's a reason behind every loss. And so every loss that you have, you will learn something from it. Now, what you have to decide is if you're going to learn, if it's going to cost you $200 to learn, $2,000 to learn, or to me today, $4,800 to learn. I don't know. You have to decide what it's going to be when you do learn, okay? Because as you continue to document your trading, you will know what you did wrong, you will know what you did right, and you're more likely to repeat what you did right, okay? And so the same thing is when you think about our brain. The right side of our brain is that fixed mindset. It's emotions. You are not going to make it as a trader if you are emotional. And when you think about emotions, I'm going to tell you what I mean by that. An emotional trader is somebody who look at the charts, they see a candle, and they see a big old, they might see a long candle, green or red, and you just be like, oh, I'm finna jump in here and get that money. That's an emotional trader. Chasing candles is emotional trading. You're not following a strategy. You got a fear of losing. So you just jumping in. That's gambling. And that's an emotional trader. Emotional trader is somebody who take a trade based on where they think the market is going. Well, you know what? I think they about to go up. I know they about to go up. I'm finna go ahead and get in my position because I ain't finna miss it because I know it's about to go up. Anytime you take a trade based on what you think and not what you know for a fact, you're an emotional trader, you're going to end up losing money, okay? Now, the growth mindset, which is the left side of your brain, that's the logic side of you. A person who trades logically, which is where I want all of you to be. I want you to be technical traders. You look at your chart and say, what is the markets giving me today? Do I have a trending market or do I have a choppy market? Do I even have a trade for today? Where is the market telling me they want to go? What is the math looking like? And you take logical trades, not emotional trades. And you will know if you're an emotional trader or a logical trader. Because most emotional traders, you get lucky and you may win and you be so excited, but when you lose, you out of there. You lose big time. And then you go back, and then when you lose, you say, I lack discipline. And so what that means is you're not a logical trader. You're an emotional trader. And emotional traders, you're really gambling. So I need you to start working on that left side of your brain, because most of us are moved by the right side of your brain, your emotions. That's what happened to me today. It's emotional trading. That is always the wrong trading to do. Okay. So you got to get your mind right and you got to focus on that. Spend a lot of time focusing on that. How do you feel about money? You know, if you're the type of person who think money is the root of all evil, then guess what? Trading ain't going to be for you. It's just not. All right. Do you have the mindset that's going to attract money to you? Are you positive? Do you do positive affirmations? Do you meditate? Do you pray before you get into the markets? Because that can help center your energy and center your mindset so that you see correctly and you're not blinded by emotion and greed, because greed is emotional trading as well. And that's when you get in a trade, you got money and you won't even ring the register because you're trying to get more money. That's greed. That's emotional trading. That's emotional trading. Okay. And so it is important that you have vision and that you set goals for yourself, how much money you want to make, how much money you want to make on a monthly basis, on an annual basis, and you're going to set a plan in place so that eventually you get there over time. Okay. This is not a get rich quick. And even though you may see us post results of people who did really, really well, they did not do it quick. They have learned how to trade over time. And that's what you need to do. And I also want to make sure that I hit on what I call God's promise. And if you are, you know, into the religion, and you start to read the Bible, you'll realize that God gave us a secret formula on how to attain abundant living in this earth that he gave us dominion over. And what you'll know is that there is a seed time and there is a harvest time. And so for most people, they want the harvest, but they don't want to plant the seeds, meaning that people want the money, but they don't want to do the work to learn how to get the money. And so what you got to understand is there's a seed time. The seed is the education. That's why you're here. That's why I'm teaching, for you to learn. But just because you plant seeds, you want to make sure that you plant seeds in good soil. This is a good scout strategy. It's tested, it's true, it's results. You ain't seen it, okay? You ain't seen it in me, you ain't seen it in my students. So you got some good soil. And the reason why I say that is because there's a lot of people who are in other Forex trading groups, and they're not making no money. And they might have been in there for 6 months, a year, 2 years, and they still not making money. So that means that they are learning, but they're not learning in good soil, and you have to know the difference. And so in this group, this education is in good soil. And just because you plant seeds, meaning just because you be here, you still got to water it. When you tend those fields, you got to plant your seeds in good soil, and you need to water. You got to water it. You planting anything, you got to water. It needs water. The water in this group is the application. That means, guess what? You got your demo account set up. You got your demo account set up. You start taking practice trades. There's people in this group that got access to all this information and haven't even started trading because they ain't even got their chart set up. And I'm not talking about new people. I'm talking about people who have been in here 4 months, 5 months, 6 months, and you still ain't got your chart set up. Why are you here? At this point, you just wasting time and space. That don't make sense. That means that you are getting information, but you refuse to put it to work. So what does that mean? You're telling me you don't want it. That's what you're saying. And so again, why are you here? So you got to apply it. Set up your charts. Start taking your trades. And then the second thing is time. Because see, the one thing about God is not, God can create miracles. Yes, he can make it super fast for you. But the thing about God is you don't know when your breakthrough is going to happen. You don't know when the blessing is going to come. You just got to have faith and do the work. And so you got to put the time in. Like I said, you either going to win or you're going to learn. In your losses, you're going to learn. Every time you lose, there's a reason. And so as you continue to practice trade, don't rush yourself. This is not a competition. Go at your own pace. That's why these videos are recorded, so you can rewatch it over and over again. If you do this, seed, water, time, your harvest gonna come. You're gonna catch some pips. And as you catch pips, you're gonna catch profits. And I want you guys to really be in the mindset of mastering the strategy that I'm gonna teach you next week and mastering catching pips. Because a lot of times you're chasing money. And when you chase money, that doesn't tell me whether or not you've mastered the strategy. You're just telling me you're making money. And so I want you to master getting pips. Because if you can master getting pips, the money is going to come to you. It's going to come by default. Okay? So I want everybody in the comments area. I got one little question for you. And that question is, would you rather have $1 million today or a penny doubled every day for 30 days? I want y'all to throw y'all answers in the chat. Would you rather have $1 million today or a penny doubled every day for 30 days? What is y'all answers? Because this is all about compound. Okay, so this is all about compound interest, because again, your money should always be having babies. So it should be multiplying. When you are working a job, you only pay for them 40 hours. If you're getting overtime, it's only so much overtime that you can get. But you want your money to be able to compound even without you participating or putting any more money in it. And so everybody definitely said you rather have a penny doubled every day for 30 days. Because if you do take a penny and it doubles every day, in 30 days, you got $5.3 million. $5.3 million versus just $1 million. And so again, a lot of people don't know the power of compound interest. They only know how to trade time for money. Now, your goal for being in this class is I want you to be able to create your own job where you're not depending on some outside company to give you a job. Because remember, like I said before, you don't own it, you don't control it, and you can lose it at any time. So you got to have some income insurance in place just in case something happens. And so I'm here to tell you that trading in the Forex market or any financial market can allow you to recession-proof your income. And so all you got to do, you can spend an hour to 2 hours a day. If you could commit to an hour to 2 hours a day to just look at charts, take a couple of practice trades here and there, you will build a skill level that will allow you to make money from the comfort of your home. Now, you can get started for a small investment of, I say like $150 is what you can put in a live trade account when you are ready to trade live. Now, you can go smaller than that, but I'm going to say do no less than $150. And so the strategy that I'm going to teach start next week, when we go into session number 2, is a trade strategy that allow you to draw minimum $50 to $100 a day out of the financial markets. And so that's an extra, $1,200 to $2,400 cash. Because sometimes people look at that and be like, $50 a day, that ain't no money. Yes, it is. That's $1,200 extra a month. And this is just minimums. Okay, so this is powerful. There's a lot of people who right now could use an extra $1,200 to $2,400 without selling or recruiting. And that's what trading allows you to do. And so all you're going to need is you're going to need a phone. You're going to need a computer. Now, I will tell you that for those Mac people, the Mac users that are out there, I don't know why y'all got them MacBooks. But for the Mac users, the MetaTrader software is really hard to run on a Mac computer. But we do have a few Mac users that are in the group. When you go to our Forex group in the search field, if you type in Mac computer, you'll see where one of the team members posted some instructions on how you could possibly have MetaTrader 4 installed on your Mac. You may have to purchase some additional software or something like that, but you can't see that. I recommend that everybody just invest in themselves, take $200 and buy you an HP. You guys, buy you an HP computer. HP stock went through the roof because everybody working from home, everybody trading now. Get you an HP because MetaTrader 4 works very well with Windows. Okay, and then you're going to need my powerhouse trade strategy that you're going to start learning next week. Now, what's the difference between stock and Forex? Okay, with stock, because sometimes people get confused, they think it's the same thing, and it's really not. With a stock, what you're doing is you're buying a stock to own that stock, and you own a piece of the company. So when you own a share of stock, you own a small piece of that corporation. You are tied into that corporation, and you're hoping that that company will continue to grow and the price of the stock increases so that you can earn appreciation. You can make a profit from where you bought it, sell it at a higher price, and that's your profit, okay? So when it comes to stock, in order for you to trade stock, you have to own it first. So you got to buy a full share and you got to own it. So you got to own it to be able to sell it. With Forex, it's different. With Forex, we don't really own anything. What we are doing is we're really trading contracts. That's what we are. And what we're doing is we're taking a position in a currency at a certain price. So if we think that the price of a currency is going to increase, we can go long, or better yet, meaning we can buy. We could place a buy on that currency with the intention that it is going to raise in price. And when it raises in price, we can close out our position and we can take our profit. Okay? Now, the difference with stocks is you have to buy it, and then you got to hope the price goes up in order for you to make some money. With Forex, we can make money when the markets go up and when the markets go down. So again, we're buying contracts. So we can take a position in a currency. And let's say we think that that currency, the price of that currency is going to go down. Well, we can take a short position. So that means that we could actually short the market. We can hit sell because we have a stake in a contract. And so we can short our position. And as the price falls, we can make money on the drop. So unlike stocks, you know, with stocks, the price fall, you don't make no money. You don't make no money, okay? And you can lose money, right? But actually in anything you can lose money. But in stocks, you can only make money when the price goes up. With Forex, you can make money when the price go up, and you can make money when the price goes down. And being able to hedge and leverage and speculate price is a powerful way to make some extra money. So what is Forex? Forex is short for the foreign exchange markets, okay? And foreign exchange is nothing but currencies. Okay, every country has a currency, right? It is one of the most liquid financial markets in the world. About $6 trillion hit the Forex markets every single day. So if we just look at asset classes, $28 billion hit the New York Stock Exchange every morning. $191 billion hit the equities market. $437 billion hits the commodities futures market, and then 1.9 trillion. And the reason why I say 1.9 trillion is that even though 6 trillion hits the markets every day, as retail traders, we only have access to $1.9 trillion. So as you can see, Forex has the biggest market, but everybody know me. I teach my team to trade all the asset classes. So we just not put in one place. We can trade Forex, we can trade futures, we can trade stocks, we can do options, we can do crypto, we can do it all. Okay, because once you learn how to become a trader and become a master trader, you can trade anything. So as you can see, $220 billion an hour hit the market. So it is liquid. So let's think about currencies. Think of it like this. Let's say you about to go on vacation to Mexico. Okay, so you're coming from the United States. So you go down there with your money. You got your US dollars. Okay, well, once you get to Mexico, if you want to buy anything or you want to go to a restaurant, you are going to have to convert your dollars into pesos because that is the currency for Mexico. And so for every $1 US is equivalent to $18.80 in pesos. So $1 is equivalent to 18 in Mexico. So as you can see, the dollar is appreciated because it has greater value, and the peso is depreciated. So obviously you go to Mexico, you can get a whole lot for your money because of the value of the US dollar. And so that's what we're doing. What we're doing is we're just trading price fluctuations between different countries' currencies. Who are the major players? Well, the major players in the Forex markets is obviously our big institutions, are like the Citibanks, the JP Morgans, the Bank of America, the Merrill Lynch. Again, every country have their own government, their players in there as well as global businesses, because in order for businesses to open shop in Europe or some other country, they are going to have to participate in the Forex market. And obviously we know the banks, the banks do, and us. So we are the retail traders. And because of, technology and the internet, we're able to participate in the big boys game, where before we was actually locked out of this environment. And so we've been able to take advantage of that, which makes Forex so attractive. I want you to think about banks, okay, and how banks make money in the Forex market. So when you go to your bank and you put $10,000 in your savings account. Well, you already know, especially if you're in my econ, you already know that that $10,000 does not stay there. You have 10,000 on paper at that bank. Now, obviously, every bank has to have reserves in case somebody come and say, give me all my money. But for the most part, as soon as you deposit that money into your savings account, the bank is going to take that $10,000 and they lend it out to other people. So they lend it out to businesses, small business loans. They lend it out to people who might want to get a mortgage. They lend it out to people who want to buy a car. And so what they do is they can make money, because when you put your money into that savings account, they're paying you less than 1%. And then they're going to turn around and lend that money to somebody who's buying a car. And let's say the person who buying a car may not have great credit. So they may give them an auto loan, but they might be charging them 8%, 10%, 15% on an auto loan. And so they made money on the difference between what they paying you to use your money and what they charging somebody for lending the money. So banks make money off of you. And banks also take their money and they put it in the Forex market so that they can multiply their money. And that's why everybody in my econ, we know we don't keep our money in the bank. You keep very little in your savings account, but the majority of your money, you want it working for you. So you're putting it in assets that is paying you more rate of return. Okay. And so that's why we trade, because we get to make money just like the banks make money. Now, the markets are available 23 hours a day for currencies. So you can literally trade 23 hours a day, 6 days a week. And this is Eastern Standard Time. So from Sunday, 6 p.m. Eastern to Friday, 5 p.m. Eastern, you can be in the markets. On Saturday, the markets are closed for currencies, but it is open for cryptocurrency. So what you will learn is that many of us trade, you can trade cryptocurrencies at any time, but we do spend our Saturdays trading, Bitcoin and other cryptocurrencies. Okay. And so even though the markets are open 23 hours a day, there's only certain times where there is a lot of volume. The more volume, that means the more money that's being dumped in. The more money being dumped in, you're more likely to win on your trades. And so every major bank has a certain time. So the US has our New York session, which is from 9 a.m. Eastern to 5 p.m. Eastern. There is the overseas markets. So there is the London session, and the London session is really big. I want to say maybe 60% of the money that dumps in the market is coming out of London. So 4 a.m. Eastern time to 12 p.m. Eastern time is the London session. The Sydney session is from 6 p.m. to 2 a.m. Eastern time. And the Tokyo session is from 8 p.m. to 4 a.m. Now, the best times to trade is when two sessions overlap, two different bank sessions overlap. So if we look at the US London session, you will see that it overlaps at 9 a.m. to 12 p.m. Eastern. That's why people who've been trading, we know that we get into the markets. I got the Eastern and the Central times here. I'm Central time zone. So if you're Central, the money is in the markets at 8 a.m. to 11 a.m. And so that's why you'll hear a lot of us make all of our trades from 8 to 11. I'm usually out the markets probably between, the latest is 10. Most of the time I'm out the markets by 9 a.m. Okay, because I like to trade when the money is trading. Again, it's available 23 hours a day, but if you want to be profitable, you want to win more, trade with the big boys when they come in. Okay, the Sydney Tokyo, the best time to trade is obviously 8 p.m. to 10 p.m. What am I looking at? I'm looking at Sydney. Yeah, Yeah, right when they're closing and opening. So 8 p.m., 10 p.m. And so what you'll find, like I said, in Central Time, from 7 p.m. to 9 p.m., you will see a spike in money. I don't know if you sit and you study your chart, you will see it. Right after the markets open at 5, it kind of goes in a certain direction. When the markets open at 5 p.m. Central, 6 p.m. Eastern, it'll kind of give you an idea of where it's going. So when the markets open at 5, if it shoots up, they're going to be moving up. If it shoots down, the futures overnight market is going to fall down further. Okay, so always be mindful of that 5 p.m. Now, again, you will notice that it gets really, really, really slow. And then between 8 and 10 Eastern, 7 p.m., 9 p.m. Central, you will see a spike in movement. So if you sit and look at your chart, you will see it. All right. Also, there is the London, Tokyo, where they overlap. And that is from 2 a.m. to 4 a.m. Eastern, or 1 a.m. to 3 a.m. Central. And this is when you hear people who are trading Forex in the middle of the night. They're trading the London, Tokyo session. Okay. Like I said, the most money is the U.S. London. That is where the majority of the money is, followed by the London, Tokyo session. So again, you can trade 23 hours, but I prefer that you stick within these time zones. Okay. And later on at the end of this presentation, I'll give you a couple of more times where you may find some volume, but I want you to stick to these money makers. There are many currencies. Every country has a currency, but there are 8 major players. And so the first is the United States, which is the USD. Our currency is the dollar. 85% of all currency trades includes the USD. Okay, the US. The second currency is the euro, which is Europe, and that symbol is EUR. 39% makes up the euro. Of all currency trades that happen, make up the euro. And that's why you see a lot in EUR USD, and that's the euro in the United States, which obviously is good during the US and the London session. Then we have Great Britain. They have, their currency is the pound. Then we have the Swiss franc, and their symbol is CHF. And then we have the Australian dollar. Their currency is the dollar. Their ticker is AUD, or their symbol. And then we have the Canadian dollar, CAD. We have New Zealand. Their currency is the dollar. And then we have the Japanese yen. Okay. So again, there are tons of currencies you could trade, but these are the 8 major players. So when you're learning, stay within the 8. Okay. Now, there are, even though we just talked about the 8 currencies, the country currencies that are traded the most, there are 7 major currency pairs that are always traded by the majority of the banks. Okay. And so again, there's a lot of different setups that you can have and different currency pairs that you can trade, but stick to the top 7 when you're trying to learn if you want to trade currencies, because you guys are going to learn what I actually trade. Okay. And so the 7 currency pairs is the EUR USD, which is the Eurozone United States, GBP USD, which is the United Kingdom and the United States. So basically Great Britain and the United States. We have the USD JPY that I do love. That's United States and the Japanese yen. USD CHF, which is United States versus the Swiss franc. We have USD versus CAD, which is the United States dollar versus the Canadian dollar. We got AUD versus USD, which is the Australian, the Aussie versus the US dollar. And then we got New Zealand and the United States. These are the top 7 major pairs. So when you be thinking about, you know, maybe you want to trade currencies for the day, you want to first look at these 7 pairs first before you start looking at other things. 72% of all volume, all Forex volume, is in those 7 pairs. And then, like I said, there's tons of other pairs you could trade. Some of the minors, as you can see them listed, EUR GBP, EUR JPY. You might see CHF and JPY. So the Swiss franc against the Japanese yen, you may see that quite a bit. And then there's what they call exotics, and that is other foreign countries that are out there that's not traded as much, but you can. So the US dollar versus Zaire, in Africa. So it just depends on what you want to do. But for training purposes, if you want to trade currencies, stick for the top 7. So write them down, have those top 7s of what you're looking at. Okay, so let's break down what a currency pair is, okay? Just the basic terminology of it. And so anytime you see a currency, it's always one country versus the other, okay? And the first currency that is listed in a pair is called the base currency. The base currency is the currency that you are taking your trade upon. So that means if you pull up a technical chart of the EUR USD, if you see that prices are falling, that means that the euro is falling because that is the base currency. So you're always looking at, that's going to be your euro, and the USD is your quote currency, okay, which is the amount needed to buy or sell 1 euro currency. All right. So anytime you buy one currency, you're selling the other one. So you're pitting 2 currencies against each other. So with the broker that we use, and I'm going to talk about that in a minute, when we want to place a trade, we have what we call a one-click button, and it just allows us to get in out of a trade extremely fast. So this is what you are going to see once you get your system set up. And so when you do, you'll always know right here on the left-hand side, at the top of the button, you see EUR USD. It always lists the currency pair that you are trading at the moment. And next to it is the time frame of your chart. Okay, and we have the ability to change that. We'll talk more about that next week. So let's look at the button. So on the left side, you got a sell button, and on the right side, you got a buy button. Now, if you think that the price is going to go down and you want to make money off of that by shorting the market, you're going to hit the sell button. Okay? It's also known as the bid price. So that means that if you hit the sell button, you are shorting the euro. You're shorting the euro. Okay, and it's always the lowest price between the two. If you think that the price is going to go up, then you're going to hit the buy button so that you can go long. So that means you want to go long on the euro, you hit buy. If you want to short the euro, you're going to hit sell. Now, these little numbers are called pips, okay? And normally, you're looking at the 4th digit after the decimal, okay? Now, sometimes you might see a currency and it might be 85.39, and then it might go up to 83.40. Well, then guess what? That's 1 pip. In this case, we got 4 digits. We got little pipettes here too, little tiny digits in the upper right-hand corner. Now, what I want you to know is whenever you see a currency that has more than 2 digits after the decimal, that is called a fraction. It's a fractional. That means that the broker has the ability to change the spread. That means that there's a spread, and they have the right to change the spread based on volatility. So if something crazy, like today, the markets went literally in a free fall. And so what you may have noticed is if you trade the US 30, once not at the breakout, but down when it kept falling, you may have noticed that your spread increased. I know I noticed it in the futures market. The spread increased because there was a lot of volatility going on because nobody was knowing why this was happening. Okay, so they have the ability to change the spread any way they want to, but they'll usually increase the spread if there's higher risk. So if some serious uncertainty is happening, the spread is going to be higher. Okay, and so when you look at the fourth digit after the decimal point, you see this 5. This is a pip. The whole digit is a pip. The smaller digit in the upper right hand corner is called a pipette. Okay, so if I just look at the difference between these two, 55 with a 7 versus 56 and a 3 means that the spread is 1.4. It's a 1 digit, 1 point spread, and then with the pipettes, the 7 from the 3 will give you 4. So the spread is 1.4. Okay, and the spread is basically a part of the broker's fee. Just so you know, when you place a trade, you gotta pay fees. Okay, so that spread is the fee. And usually when you are trading, especially when you're trading the currency markets, you will hit buy or you will hit sell. It's not going to put you in at the exact price that you hit the button on. It's going to include the spread. So usually you have to get into profit, make up for the spread, and then you start getting into profit. And I'm explain that in just a minute. Okay. So let's talk about, because I want you to truly understand what you're trading when you trade in the Forex market. A standard lot size for trading Forex is $50,000 contracts. 50,000. So anytime the big money, the banks, the institutions, when they buy one lot size, they are trading $50,000 at a time. Okay. If you deposit $1,000 into a broker account, it will give you access to standard lot size. So that means that you'll be able to trade $50,000 contracts with $1,000 deposit. Now, there are brokers that will allow you to get in the game for less than $1,000. And so there are some brokers out there that allow you to trade what they call mini lot sizes. And mini lot sizes, you have to put up $100 and you are trading $5,000 contracts at one time. And then there's other brokers like what we use Hugo's Way. Hugo's Way allow you to trade micro lot sizes. So that means that you can put $10 to $50 into your account. So it's $10 if you just want to trade crypto. It's $50 if you want to trade currencies or indices. And it will allow you to trade $500 lot sizes. I mean, $500 contracts off one lot. You guys got to understand what you're really getting access to. That's why for most people, we were out of the market. We was out of the market because who had 50,000? Okay. And then there's some people who didn't have $1,000, so they was out the markets. And now with these new brokers and because of technology, they've created all these little micro sizes to make it easier for ordinary people like me and you to be able to trade with the big boys. Now, all U.S. brokers, you're able to do what we call leverage. And that means you're able to leverage more of a contract with less money. You could do more with less. Now, U.S. brokers, you can have leverage of 1 to 50. That means your money, whatever you deposit, is 50 times that is what you're going to be able to trade. With Hugo's Way, our leverage is 1 to 500 because we're using an international broker. Okay, so with a U.S. broker, the legal limit in the United States is 1 to 50. 1 to 50. And that is why most people are using international brokers, because they can leverage 1 to 500. Okay. And that's what Hugo's Way allow us to do. So if you put $1,000 deposit into Hugo's Way, you open up your live trade account, you put $1,000 in. Well, guess what you can do? You can leverage your account 500 times. So 1,000 times 500 is almost $500,000. It is $500,000 contract. So it's like putting $500,000 in circulation when you take one trade, if you put $1,000 in the market. And so what happens is when you deposit your $1,000 into Hugo's Way, what Hugo's Way is doing is loaning you $500,000. Now they're not putting $500,000 in your account, but that's the money that they're putting up to allow you to trade. So they put up $500,000. Let's say you take a trade and you catch 50 pips. And depending on what your lot size, but let's say when you caught 50 pips, you made $500. So what Hugo's Way is going to do is they're going to give you back your $1,000 deposit minus the spread, which is the fee. And then they're going to give you $500. And let's say the spread is costing you, it cost you $5. That means that your new balance, instead of being $1,000, is $1,495. Now, the reverse is if you lose. So you put up $1,000 and then you lost 50 pips. You lost $500. So what they're going to do is they're going to take the $500 plus the spread from your $1,000 deposit. And your new balance is going to be $495. That's how it works. So they're allowing you to get in the market and move big money with just a little bit of money. And so that's why most people, and myself included, lean toward international brokerage companies. Now, there are always pros and cons of using an international broker because it's international. There is a lot of red tape when we are getting our live account set up, because you're going to have to do identification, verification. There's a little bit of red tape when you are funding your account, red tape, getting your money out. That is the cost of being able to leverage more with less. Okay. And so at the end of the day, if all you want to do is currencies and that's all you want to trade, you can use a US broker. If you want, but most US brokers, you cannot trade indices. So for most US brokers, you might can do currencies, and you can do crypto, but you are not going to be able to do indices or stocks with US brokerage companies. And so that's why I'm doing international, because I want to be able to trade currencies, indices, crypto, and stock all in one place. So again, the broker that we're using Hugo's Way, and there's other international brokerage companies that are out there. I will probably test some out just to see how they go, but right now this is what I have been using. You can get started for as little as $10, and again, that's if you're trading cryptos. $50 if you're trading our currencies. With the crypto, your leverage is 1 to 100. With currencies, it's 1 to 500. I do like that you could trade micro lots. You know, so you could trade 0.01. They allow you to use pretty much about 99% of your money before they do a margin call. So that's pretty cool. I will tell you that when you are using a US company, oh my goodness, they margin calls be so early. You be like, man, they taking me out of trades too soon. And they do have pretty reasonable commissions due to the fact of how much money they're actually putting up on your behalf. And so let's talk about lot sizes. As you can see in our one-click button, the lot size is the number in the middle of the box, the 1.00. So again, you can trade micros. So at the lot size, and the lot size determines how much you make for every pip. So when a pip moves up 1 point, it's equivalent to money, okay? So if your lot size is 0.01, you're getting 10 cents per pip. If your lot size is 0.10, you're getting $1 per pip. And this is mainly currencies. It's a little bit more when it comes to indices. The 1.00 is equivalent to $10 per pip. The $10 lot size will give you $100 for every 1 pip in the right direction. And 100 lot size will give you $1,000 per pip in the right direction. Now, your lot size is going to be dependent on how much money you put in, but this is the rule of thumb. So as we talking about lot size, we also got to talk about risk management, because just how you can make money, you can also lose money. And so there is a rule of thumb when it comes to risk management. Most hedge fund institutions, in any major professional, people who are responsible for billions of dollars, will not risk no more than 2% of their account balance. And this is something that you want to do. Okay, so I want you to put this in this mindset, because I really wanted to hit on risk management. Don't do nothing that I do as far as trading naked. Don't ever trade naked. Never trade without a stop loss. Never ever do that. Okay, but I want you to think of it this way. Every time you trade, you got a 50-50 chance of being right as a new trader, until you get the discipline that is required to increase your win rate. For right now, it's 50-50. Okay? So you got a 50% chance of being right and a 50% chance of being wrong. So let's say, for example, you put $100 in your Forex trade account. If you risk 50%, if that's your risk, 50%, that means that you're risking $50 every time you place a trade. So obviously, if you have 2 consecutive trades, bad trades back to back, you're going to blow your account. And the possibilities of you doing this is 1 out of 4. 1 out of 4. And this is consecutive bad trades. When you get started, you can, trust me when I say you can have consecutive losses. You could take 2 bad trades. And if you put $100 in there, your $100 went just that fast. You could do that in a day, in less than 30 minutes. If you risk 25% of your account, that means that every time you take a trade, you're willing to lose no more than $25. That means that after 4 consecutive bad trades, you will blow your account. You got a 1 out of 16 chance of doing that, of taking 4 consecutive wrong trades. 1 in 16 chance. If you risk 10% of your account, that means that you will only lose no more than 10. You're only willing to lose $10 every time you take a trade. After 10 consecutive, not win, lose, I'm talking about 10 losses back to back, then you'll blow your account. After 10 bad trades consecutively, you got a 1 in 1,000 chance of actually doing that. If you risk 5% of your account, 5%, that means that if you put up $100, you only want to lose $5. That's it for each trade that you take. You would have to take 20 consecutive bad trades to blow your account. 20. You take 20 trades and all 20 was wrong. That's a 1 in a million chance of happening. Of you not winning one time out of 20, 1 in a million. If you risk 2%, that's $2. So every time you take a trade, I ain't losing no more than $2. That means that I would have to take 50 bad trades back to back to blow my account. And that's 1 in quadrillion. That's why I put them question marks there. It's past, it's quadrillion. And so what I'm saying is, the lower your risk, you're able to lose and not blow your account. And the possibilities of you taking 10, 20, 50 bad trades back to back with no wins, it's just not going to happen. And so what you're doing is, by having a 2% risk, you giving yourself a chance to learn without losing money. Okay. But if you jump out there and you haven't thought about looking at the risk, then obviously you're going to lose, like I did today. It happens, right? When you don't follow your system. So I want you to look at it from a money perspective. Let's say you open up your Forex account with $1,000. And remember, we're talking 2% risk. So if you put $1,000 in, that means that you're only willing to lose $20 in any one trade. So what is that from a lot size perspective? If your lot size is $1, that means that you can only lose 2 pips. And you got to be out the trade. If your lot size is 0.10, then you can lose 20 pips and you out the trade. If your lot size is 0.01, you can get a 200 pip drawdown, and it probably go into your favor. So for most people, you're losing because your lot sizes is wrong, because you're chasing money and not chasing the pips. I want you to master the strategy. The strategy is what matters. If you catch the strategy right and catch the pips, the money is going to come. If you got a $500 account, you can only lose $10 per trade. And even when you're looking at MetaTrader, it's telling you the amount of money you down. So if you got a $500 account and you down $50, you should have been out that trade. Like me. Don't do me, right? So that's $10 per trade. So at the dollar lot size, guess what? You can only lose 1 pip. So that means you got a $500 account. You shouldn't even be doing dollar lot sizes. A 0.10 lot size, you can risk 10 pips. 0.01 lot size, you can take 100 pip drawdown. You got $100 in your Forex account. You can only risk $2 per trade. So 0.10, you can't even do dollar lots, but 0.10, you can only take 2 pips. 0.01, you can take a 20 pip loss. And so there's people who opened up their accounts with $100 and they blew them fast. But then when you look at their lot sizes. Why was you at that lot size at $100? It should be at 0.01. You got to get the strategy down. Once you get the strategy down, you can always increase your lot sizes. But you got to get the wins first. Get comfortable with the wins, and then the money is going to come. And so with your stop loss, there are a number of ways that you can do your stop loss. You can do your stop loss based on your 2%. You can do it based on the money. You can do it based on the number of pips. Now, me personally, my stop loss is the last either resistance or support. So if I'm buying, the last support level is my stop loss. If I am shorting the market, the last resistance is my stop loss plus 5 pips to give myself some wiggle room, because sometimes it'll go back and test the resistance and support and then go in the direction that it really supposed to go. So they do that. So I usually add like 5 pips on top of that. Now, my stop losses always end in an odd number. So my stop losses, the number, the last digit that you see has to be a 7 or an odd number. So I'm just going to say a 7 or a 3 in this case. But the only odd number you do not want to use is 5, because 5 is the number that most option option contracts are based on, and sometimes they'll move the price action to hit those option contracts. And so sometimes it'll hit your stop loss because you were either on an even number or you were on a 5. Never let your stop loss be in the last digit be on a 5 or an even number. Only odd numbers. Cinta, which shout out to Cinta. For the month of August, she had a $41,000 month in her live trade account. Now, what I will tell you is, you know, I had put her picture on there, but when I went back and I looked at this screenshot that she posted, because it didn't have her picture on there, I was able to look at the pips. And I can tell when she's chasing a candle and when she stuck to the strategy. Because if you stick to the strategy of the breakout strategy, you will catch a minimum of 50 pips every time you do it in one trade. And so if you look at the trades where she made 2,000, 6,000, 7,000, 5,000, 2,000, you will notice that she caught 150 or plus pips. So that means she caught the breakout, meaning she traded the strategy. Because see, when you chasing candles, you can't catch 100 pips because you're chasing, you didn't get in at the right time. But because she has disciplined herself to just trade the strategy, she had way more wins than she had losses. And so just in 2 days, just looking at this screenshot, even though it was over a course of a month, but just looking at the screenshot, in 2 days, she caught over 500 pips. She caught over 500 pips in 2 days. The strategy works, but you got to learn the strategy, but you got to discipline yourself to do it. You got to catch the pips. The pips will lead to the money. Never fails. Now, when you take a trade on Hugo's Way, I just want to show you when you get in a trade, they have a little trade, what you call it, a little trade panel where you're going to be able to see. Okay. So when you place a sale, let's say this person took a sale, which means they think that the price was going to go down. I don't know why I'm trying to get my little pointer here. It don't want to act right. Okay. So right here, you're in a trade. You hit sale, you think the price is going to go down. You got your lot size is 0.01. You happen to be trading the US 30. It's going to list your price you're in. If you got a stop loss set up, it will tell you the price your stop loss is set. And then your take profit is here if you set that. So you have the ability to set your trades up. I want to get in at this price. I want my stop loss to be here. In case I'm wrong, it'll take me out my trade. I'm not risking such and such amount of pips, you know, based on your risk management. And then you can set your take profit. So you can manually do it or you can enter it in a box. And we'll talk more about that tomorrow. Okay. And then you'll know what your commission is. And the commission is based on pips, as you can see. And then there's a swap. The only time you will see a number in the swap is if you leave your trade open more than a day. If you leave your trade open more than a day, then you will get hit with a swap fee. Because remember, they loaning you money. So if you don't close out your trade, their money is stuck there. So they're going to start charging you interest. And so you can leave your trades open if you want to, but just know that you're going to be charged a fee. Okay. And so when you start looking at your tickers, and we'll talk more about this next week, but once you set up your charts, you're going to be able to see tickers of different asset classes that you want to trade. But what you're able to do is you're able to put your cursor on a ticker, right click, and you're going to get a drop down box. When you click on specifications, it will give you more details about that contract. So it's basically telling you the contract size is 100. You know that your currency is USD. You know what the margin is when you trade it. The margin is 0.5%. Like I said, they pretty much let you use almost 99% of your money. And then you got market orders here. And then they also tell you the interest rate of the swaps. So if you go long and a US 30 and you leave your trade open and you in a long position, this is the interest. If you're shorting, this is the interest. Okay? So just be mindful of that if you decide to leave a trade open for multiple days. Okay? So again, every time you buy, you're locking in 100 contracts. They're putting up the money for you. Okay? The type is always the position. You're either buying or you are selling. If you think the price gonna go up, you hit buy. You think the price gonna go down, you hit sell. The lot size is what you're gonna be paid per pip. It's really simple. Okay? Your commission fee is round trip. So the amount for the commission is what they're going to pay you when you get in the trade and when you close out your position. Now, what you see also on the trade transaction, on the right-hand side, you will see something that says profit. So when you get in a trade, you know immediately how much money you have made or how much money you have lost. It tells you. It ain't no guessing. You have the ability to close out a trade at any time by just hitting the X. When you hit the X, you are out the trade. It rings the register. Okay? Now, if we look at this gray bar here, when you're in a trade, you'll see this. So let's say, for example, in this Forex example, you got $1,988 in your Forex account, but you ain't got into a trade. So when you got into a trade, it is going to tell you how much free margin you have. Okay? So that means that that's how much money you got left right now to use in taking an additional position trade if you want to. Your equity is how much money you have made or lost in your current trade. All right? So if you're in this example, let's say in this example right here, you know, you're losing $16. Your profit is a minus $16. So you had $19.88, but now that you're in this trade and you losing money, your equity is what you got right now in your account, which is $1,966. If you was winning, that equity would be more than what's in the balance. All right? Your margin is telling you that if your free margin, which is the money you got left right now, if it hits below $131, they are going to take you out of that trade. Okay? So once your account hits 70% of the free margin balance, they're going to hit you an alert. And you're going to see a red note at the bottom of your Hugo's Way laptop platform. I don't know if they show you something on a mobile. I know they show it on your desktop. They're going to give you an alert that says, hey, you're close to hitting your margin. So that's telling you, if you don't want them to take you out, you take yourself out. Okay? And what they're saying is they'll let you get all the way to $131, and then they'll automatically close your position. So you can go from $1,988 to $131. The choice is yours. But at any point in time, you could have closed out. All right? But this is what they have set in place so that you know how it works. So let me give you an example so you know what I mean by going long and what I mean by going short. So if you look at this, this is just a basic chart of candles. Each candle represents a point of time. So let's say we're looking at a 5-minute chart. If we're looking at a 5-minute chart, every candle represents the fluctuation of price in a 5-minute time period. When you see consecutive red candles, that means that the price of that asset is going down. And when you see multiple green candles, that means the price of that asset is going up. Okay? So let's say, for example, looking at the bottom of this chart, let's say we go down to the bottom. You see these long red candles consecutive. That means that the price, which was high here, is now all the way down here. Okay? And now that price, the lower price has been rejected. I'm seeing some green candles. They trying to move the price back up. So let's say I'm right here. Okay? And I say, you know what? I believe, based on my technical analysis, I believe that price is going to go up. So what I want to do is I want to go ahead and get in a trade. So I'm going to hit the buy button. And when I hit the buy button, let's say the buy button was at 1.1156. But remember, there's a spread. So when you actually get in a trade, the trade line is going to show up right here. And then let's say the trade line put you in at 1.1157. So that means that I got to, this candle has to cross this line. Once it crossed this line, it had made up for that 1.4 spread. So if the candle keeps going up, all this is money. That's how it works. So if I think the price is going up, I hit buy. Once my candle has crossed over the spread line, I am in the money and I am in the profit, and I can ride it all the way up and close when I want to. Okay? What I'll say though is always be prepared to ring your register. When you get money, take it. Here's the opposite. Let's say, you know, we got price here. Price went down, then it went up. And as you can see, it went all the way up following these green candles. It broke down some more. Then it went up some more, right? And let's say, based on my technical analysis, I believe that the price is going to go down and break down a little bit more. Okay. So I decide that, hey, I want to get in at the top of this candle. And let's say at the top of this candle, I'm going to go ahead and I'm going to hit the buy. I'm going to hit the sell button because I think the price is going to go down. So I'm going to hit sell. So I hit the sell at the price of 1.1155. When I did that, I'm going to see this line, right? Going a horizontal line going across. That line is at 1.1154. That's my spread. When my red candle, which means price is going down, when my red candle crosses that line, I've already covered the spread. If it keeps going down and I get consecutive red candles, I'm in the money. So everything after this point is money. Okay? That is how, that's what I mean when I'm talking about going long or going short. Going short means I think the price is going to go down. And let's say I decided to close my position. And when I closed my position, it was at 1.1144. After my spread was 1.1154. So that means I caught 10 pips. So let's say I caught 10 pips. So if I caught 10 pips, how much money I make is based on the lot that I have set when I took the trade. So 10 pips at 0.01, I made $1. I made $1 off of 10 pips. If my lot size is 0.10, I made $10 off of 10 pips. If my lot size is $1, I made $100 off of 10 little pips. If my lot size is $10, I made $1,000 off of 10 pips. In order to do this, You got to master the strategy and get good at catching pips. If you can get good at catching pips and you can take 10 trades and win 8 out of 10, pure discipline of following a strategy, you can start to increase your lot size as your wins start to go. Don't rush to get to the big money if you have not disciplined yourself and mastered the strategy, because you can get lucky and you can win, but you also, when you lose, you're going to lose big. There's 4 types of Forex traders. The first type of trader is a scalper. That's me. The target is 5 to 10 pips, but I never get, 5 and 10 pips is like the minimum. If you use my strategy, you should catch 50 pips. If you use my strategy and the market is trending, you'll catch 50 plus pips. I very rarely have to settle for 10 pips or 5 pips. Very rarely. The only way that's going to happen is, let's say the market is moving sideways and you want to change and you want to trade sideways. Okay. A consolidated choppy market or a range market, it might be smaller pips. But when I say scalp, what I mean is having the mindset of being able to get in and out. That means to be able to make money, ring the register, and take your profits and not allow greed to kick in. That's why I call it scalping. I get in and out. We are using 5-minute charts. Now, I really do love 10-minute charts, but that is not a default setting in MetaTrader 4. It's 5 or 15. I am looking at ways to see how we can create a 10-minute chart. I hear it's called an offline way of doing it. Once I figure that out, I will share with you. But for right now, it's 5-minute charts. The second type of trader is a day trader. And that is somebody that every time you take a trade, you're trying to catch 20 to 40 pips. Your trades are usually done by the end of the day. I don't keep my trades open. I'm always out the markets. As a day trader, you know, we do look at the daily, the 4-hour and the 1 hour, and then we trade off of the 5-minute. Okay. And then there's the swing traders. Swing traders are people who are looking for 50 to 150 pips per trade. They tend to leave their trades open for a little less than a week. They're trading off of the 1 hour and the 4 hour. Now, most people who are doing swing trades, they are trading currencies. Indices, not so much, okay? Because indices can give you your 50 to 150 pips in a day, in a couple of minutes. You don't even have to wait a week, okay? And then there's position traders. And position traders, their target is 50 to 1,000 pips. They can leave their trades open for months if they want to. They're trading off daily and weekly charts. These are people who are probably pivot point traders, and they're kind of trying to trade with the banks. But I'm going to teach you guys a day trading strategy where you can trade with the banks as well. Now, here's the pros and cons of currencies. And currencies, again, is like the EUR USD. The pros of trading Forex currencies is that you can get started for a little bit of money. $50 to $150 put you in the game. You have the ability to trade 6 days a week, 23 hours a day, Sunday through Friday. You can make money when the markets go up. You can make money when the markets go down. Now, the con of it is that when you're trading currencies at the point, I meant to say 0.1, at the 0.01 lot size, you're really getting pennies. You're getting pennies on a dollar. When you trade indices, you're getting dollars, even at the 0.01. Okay, so that's why I tend to trade indices instead of currencies. Currencies usually have a larger spread than the indices. So it takes you a little bit longer to get into your profit. And most of the volume is in the morning or the overnight session, not too much in between when it comes to currencies. So you are limited to the times you could trade if all you are trading is currencies. And so currencies is good to know. Forex currencies is good to know. But what I want to do is I want to share with you what I personally trade in the Forex market. And I call it the cake. And this is where you can get some, I call it daily deposits. And what I'm trading is I'm trading indexes instead of currencies. I could trade currencies. I do trade currencies here and there, but I want to tell you when I'm trading Forex, 90% of the time I am trading indices. And so what I am trading is the overall markets. So I am trading the S&P 500 index, which is the SPX 500. I am trading NASDAQ, which is NAS 100. And I am trading the Dow Jones Industrial Average, which is the US 30. I also trade gold. So that is the XAU USD. I trade future dollars. And then I also trade crypto. My favorites is Bitcoin and Ethereum. So that's BTC USD, ETH USD. So when it comes to crypto, you can own some, but you want to be able to day trade it. And the best way to day trade it is through the Forex markets. And what we also have the ability to do is there are some stocks that we can day trade. I think that's cool, you guys. And it gives you a little bit more flexibility in being able to make money every single day. Now, as a new trader, I want you to focus. The very first index I want you to learn how to trade is the SPX 500 because it's a little bit slower than NASDAQ and US 30. US 30 is the big one. And the US 30 can give you a whole lot of money fast, but you can blow a whole lot of money fast. So I want you to start with SPX 500, and I want you to trade gold, XAU USD. Those are the first things that I want you to trade as a new trader. As you start to win and you start to understand the strategy, then you move to NAS 100, and then finally you go to US 30. And you on Saturdays, try your hand at crypto. And then when there are, they don't have all the stocks in there, but there's some top stocks in technology that is in our Hugo's Way. And that's why I love trading Hugo's Way, because you can do some of these stocks, okay? Now, the big volume money, and this is Eastern Standard Time, when it comes to indices. I'm not talking about currency or currency pairs. I'm talking about indices. So when it comes to indices, you're looking at a little bit more, okay? So from 8 a.m. to 10:30 a.m. is all the money. 8 a.m. to 10:30 a.m., you will find money. 3 p.m. to 4:15 p.m., you will find money. 6 p.m. to 7 p.m., that's the open after the close. You can catch the money. 10 p.m. to 11 p.m., you'll catch the money. And 2 a.m. to 4 a.m. And this is all Eastern Standard Time, okay? We're talking about indices. Indices are more volatile than currencies. So you tend to find more money and big money moves faster. I don't spend that much time on cryptocurrency. So when I'm trading the Dow, that is 30 of the world's largest companies is in the Dow. So when you're looking at the Dow, you want to pay attention to the top 5 stocks that have the most leverage in the Dow, because they can move, they have the ability to move the Dow, okay? So we got our McDonald's that's in there. We got our Johnson & Johnson's. We got our Visa in there. We got our Home Depots. We got our Cisco Systems. We got the Coca-Cola. And a big mover is Boeing. So when Boeing goes down to the bottom, guess what? The Dow goes down to the bottom. When Boeing have a good day, the Dow has a good day, okay? SPX 500, which is the S&P 500 index. It is 500 of the world's largest companies. $8.2 billion is traded. It has a $24 trillion market cap, okay? And you may find some of the same companies in all of the indices, okay? But you're looking at AbbVie in here. You're looking at McDonald's again. You got PepsiCo that's in here. ExxonMobil is in here. Caterpillar is in here. Grainger, Procter & Gamble are in here, okay? AT&T is in here. Walmart is in here, Okay. Again, when these companies are doing good, the S&P goes up. When these companies are doing bad, the S&P goes down. NASDAQ, which was my absolute favorite for 2020, is 100 large cap companies, about 9.8 trillion. It is heavy with technology stock. So with NASDAQ, you want to look at the big five: Microsoft, Apple, Amazon, Google, Facebook. And what is not on here that is in the NASDAQ that took NASDAQ through the moon is Tesla. Tesla. So when Tesla was going crazy in the stock market, that is why NASDAQ was climbing the charts. So if you understand the companies that make up these indices, as they go, so do the indices. Okay. I like to keep up with stock markets because I am a stock trader. So it makes more sense for me to trade indices because that's where I spend the most of my time. Bitcoin is one of the most traded cryptocurrencies, but there's a lot of cryptocurrencies that's out there. You see a lot of people talking about, oh, you should invest in Ethereum, you should invest in Ethereum. That's fine, because cryptocurrencies are a great place to save your money, because you're gonna make more than having your money sitting in the bank because they're not paying you that much, right? So cryptocurrency is good, but I prefer to day trade cryptocurrency, so I can make just as much money without even having to own it. And so you have the ability to do that. Usually when the US dollar is going down, Bitcoin is going up. Now, what I'll tell you is when the markets did the correction back in March, Bitcoin fell with the US market. And that was the first time that happened. Usually when everybody get worried and the stock market start going down, everybody want to run to Bitcoin. But we are noticing that Bitcoin is starting to move with the overall market. So that's something you want to pay attention to. But you can use it as a hedge. And like I said, I believe it's a great way to save your money. And then we have stocks. Now, they don't have all the stocks, but they do have the top technology stocks that move NASDAQ. So Tesla, Microsoft, Apple, Boeing, Amazon, Facebook, Procter & Gamble, Netflix, and I even believe GE is in here. So if you know, based on your technical charts, that Tesla did a pullback, well, most people, they'll be trying to buy Tesla stock. Oh, Tesla went all the way down to $400. So this is the great time to buy. Yeah, you can buy some stock. Or they try to run an options trade on it, but you can jump on the Forex side. You know it's at the bottom of buy, and you can buy it, increase your lot size, and make more money than people who are trading options. So you can do that on Tesla. You can do that on Apple, Boeing, Amazon, Facebook. All you got to do is look and see what stocks that Hugo Wade offer. Set you some alerts. Look at your charts and trade your charts. So when a stock is getting ready to do a breakout, you're going to treat it like you would treat currencies or indices, and you would trade it at increased lot size. So this is powerful. And that's why I trade Hugo's Way. And so I don't just trade one thing. I trade all of it. So your Forex potential, again, there's 250 trading days throughout the year. If you made $10 a day, you'll make $2,500 a year. If you made $50 a day, you'll make an extra $12,500. You make $200 a day, you'll make $50,000 a year. You make $1,000 a day, you make $250,000. If you make $2,000 a day, you make $500,000. To get to these daily rewards, you got to master the strategy and capture your pips. $278 a day will make you a six-figure earner from the comfort of your home, just like myself. And so you can do it, but you got to understand the strategy and you got to practice. Now, for the people that is in my econ, it is important that everybody know that you got to keep Uncle Sam out your pockets. Remember that anytime you are day trading, you are intraday trading. So what that means is you're getting short-term capital gains. So you're not going to be taxed at the capital gains rate for people who are holding investments for more than a year. Yours is considered short term. So your profits, come tax time, are taxed at ordinary income. So if you grab $50,000 out the market, guess what? If you make $50,000 a year, you just made $100,000. All right. And so what you want to be able to do is you need to tie business. You tie business to your income, and you also want to be able to get some day trading write-offs as well. And so if you make 5 trades a day or more, you are considered a full-time. They consider you kind of like a full-time trader, and you don't have to pay self-employment tax. Okay, I'm a full-time trader. Everybody knows that. If you make 2 to 3 trades a day, you're considered, or none, or you don't even make a trade every day, you are considered part-time. Okay, you are definitely going to need a business to offset your income. You want to document all your trades. Now, the great thing about the MetaTrader, especially on your phone, you can look at all your income, all your wins for a certain time period. You have access to that. Next week, we'll talk more about the online trade journal that I want you to be able to keep, and that is going to help you log in your documentation. If you are in my econ, the profits that you make in your trading, you can actually log them into your cash flow manager. Your gains and losses are reported on a form 8949, okay? And you will have to do a Schedule D for itemized deductions if you do not have a business, okay? Now, for people who have businesses, we will be able to use some of the write-offs on our Schedule C. So the cost of getting set up, you went out and bought a new computer. For those of you who actually bought the class, that is a write-off as well. If you ever purchase additional indicators, that is a write-off. So you will be able to write that off on your taxes. Now, U.S. brokers, so if you choose a U.S. broker, they are going to send you a 1099-B at the end of the, well, based on the year, but they got to January 31st to mail it to you, okay? International brokers usually give an annual report statement, okay? Now, Hugo's Way don't necessarily do. So here's what I'm going to say. Depending on the broker that you use, you want to make sure that you keep up with your profits and your expenses, because it definitely can come back on you, all right? You can write off up to $3,000 of losses that you take, all right? Now, again, if you don't have a business, if you make $80,000, you pull $25,000 out the markets, you made $105,000. Even if you took away the standard deduction, your taxable income is going to be $87,000. If you were in my econ, $80,000, and let's say you made $25,000 in trading, but you got $30,000 in write-offs, because we can write off our lifestyle expenses and convert them into business expenses minus the standard deduction, we're taxed off of $57,000. So that's a big difference, because actually the tax rate dropped from 24% to 22%. So people who are trading and don't have a business is actually losing money. They're working backwards. So your homework for all our new traders is to set up your brokerage account. So what you're going to do is you're going to go to the files section. So in our Facebook group, go to files, click on files. It will show you how to open up your brokerage account. You're going to see a video on how to set up your charts. So there's one video on how to set up the charts on your computer. And then there's another video on how to set up your charts if you have an Android or an iPhone. So there's one video for computer, one video for your mobile. So your homework for this holiday weekend is to get your brokerage account open, set up a demo account. That's what you're doing, not a live trade account, a demo account. I want you to set your demo account with the dollar amount of $100 to $1,000. You decide. So whatever amount, when you're ready to trade live, ask yourself, how much money are you putting up? And how much money you put up is what you need to set your demo account up as. So if you know you're going to open up your account with 500, make your demo account 500. If you only working with 100, set it up for 100, because this is how we're going to learn if you're really following the strategy or you're gambling. Okay, so that's your homework. Open up your demo accounts, get your MetaTrader downloaded to your desktop and your mobile, and set up your charts. And all that information is under files in our Forex group. Okay, so that is the homework for this weekend. And then next week we will dive into Derek put that myfxbook.com. If you want to do that, you can, but you don't have to do that. Like I said, we do an online, I have an online trade journal. Some people can use my FX book if they want to, but you have the freedom to do what you want to do in your business. So if you want to allow people to be able to see your trades, you can do myfxbook.com. But if you don't, you don't have to. You don't have to. That's the one thing about being in this group. You got the freedom to do your business however you want to. Okay. So again, make sure y'all go back and y'all watch these replays. And get your accounts set up, and then next week we will go over the strategy, and you'll know how I get in a trade, how I get out of trade. We'll go over the charts so that you have an understanding, and then all you got to do is start taking your practice trades. Okay. All right, you guys, that ended tonight. I am absolutely out of here. Hey, Mo. Y'all, Mo all the way in Hawaii. Mo and got on this training, and he all the way in Hawaii. I don't even know what time it is in Hawaii. So you know he's trying to make some money if he all the way in Hawaii trying to be around us. All right? So, all right, y'all. I appreciate y'all. Have a good night. Have a good weekend. Have a safe holiday. And see y'all later. See y'all later. Good night.